Welcome back, traders. This is the second episode of our chart pattern series. In today's video, we're diving into one of the most explosive continuation setups in technical analysis, the pennant pattern. At first glance, pennants might look similar to flag patterns or even symmetrical triangles. But here's the key difference. Pennant patterns often produce stronger, more aggressive breakouts with a much better reward-to-risk ratio. There are two main types of pennants you'll see on the charts: bullish pennants and bearish pennants. In this episode, we'll first break down the bullish pennant pattern, how it forms, why it works, and how to trade it step by step. So, get ready to level up your trading knowledge. Let's jump straight into the pennant pattern. Pennants are a powerful category of chart patterns. They look very similar to flag patterns and symmetrical triangles in how they form and break out. But if a flag and a pennant were brothers, the pennant would definitely be the more aggressive one. A bull pennant forms after a strong impulse move. This creates the pole of the pattern. Then comes a short correction or pullback, which forms a small triangular consolidation. This consolidation is the pennant itself. Now, you might be wondering, what's the real difference between a bull pennant and a symmetrical triangle? They both look almost the same, right? The answer lies in the time and structure of formation. A symmetrical triangle usually develops more gradually and shows clear swings between support and resistance. But a bull pennant is quick, compact, and more volatile. Its candlesticks are tightly packed, making individual swings harder to spot. That tight structure is what often leads to explosive breakouts when the pattern completes. Although a bull pennant looks very similar to a bull flag pattern, it can often lead to far more explosive breakouts. Let me explain this with a simple example. Think of a Coke bottle versus a Coke can. I'm sure you've seen videos where someone shakes a Coke bottle and then pops the cap. It explodes everywhere. But if you do the same thing with a Coke can, you don't get the same dramatic effect. Why? Because of the shape. A Coke bottle narrows toward the top like a nozzle. When you shake it, the pressure builds, and all of it is forced toward a smaller exit, the cap. That focused pressure creates an explosive release when the cap finally opens. Bull pennants behave in a very similar way. After a strong price move, the pole, the market compresses tightly into a small triangular range, the pennant. That tight compression acts like the neck of the bottle. Energy builds, and when the breakout comes, it's often sharp and powerful. So, in simple terms, the tighter the pennant, the more forceful the breakout can be. Essentially, the same pressure buildup we just talked about also happens between buyers and sellers inside a bull pennant. As price contracts from left to right, volatility is about to increase. Both buyers and sellers are waiting to break out of that pullback zone. This creates the setup for a potentially explosive breakout. But remember, the bull pennant is a continuation pattern, not a reversal pattern. So instead of trying to catch the market bottom, your focus should be on using the pennant to ride the existing trend upward. Now let's talk about how to trade it. Entry, stop loss, and target criteria. One of the costliest mistakes traders make with pennants is entering too early. A pennant can feel like a tight range, but during the pullback, the price may still overshoot or undershoot the trend line. Overshoot, when the market is very volatile. Price fakes out above or below the trend line multiple times before the real breakout happens. Undershoot, the opposite. Price doesn't fully retest the trend line every time, which can trick you into thinking the breakout won't come. Being aware of these two behaviors helps you time your entry much better. In a bull pennant, our biggest concern is overshooting because the price is moving inside such a tight range. So what happens if you buy the moment the trend line breaks, or you place a buy limit order just above the swing high? Most of the time, the price will trigger your order and then slip back into the range, creating a classic fake out. This not only frustrates traders, but can also damage your account. The key takeaway here is patience. The ideal approach is to wait for the breakout candle to close above the pennant line. When you see a full bullish candle close above resistance, it signals that the buyers who were squeezed inside the pattern have finally broken free, just like the exploding Coke bottle. From here, you can place your buy entry slightly above the high of that breakout candle. But be careful, sometimes the breakout candle is very large, and buying at its high can wreck your reward-to-risk ratio. In that case, you have two smart choices. Skip the trade entirely, protect your capital, or wait for a pullback or retest of the breakout level, then go long when price starts to rise again. However, because of the explosive nature of pennant breakouts, pullbacks are rare. That's why discipline and careful entry planning are your edge here. Always validate the breakout with volume or momentum indicators. During pennant consolidation, volume usually drops, and when the breakout happens, you should see higher than average volume, a clear sign that buying pressure has returned. Now let's discuss stop loss. You don't want to park your stop loss at obvious levels such as support, resistance, or the last swing low, because that's exactly where stop hunts often occur. Instead, think in terms of pattern invalidation. In the case of a bull pennant, the setup is no longer valid when price breaks and closes below the lower trendline support. So, place your stop loss below the bottom trendline support, or more precisely, below the swing low of the pattern. But there's a catch. Because of overshooting and long wicks, a tight stop can get triggered even when your trade idea is still correct. To protect yourself, use an ATR average true range buffer. Here's how. Identify the swing low of the bull pennant. Calculate the ATR value on your time frame. Place your stop loss ATR pips below that swing low to give your trade breathing room. Finally, let's talk about targets. There are several ways to take profits with a bull pennant. One of the most reliable methods for setting a profit target is the measured move approach. First, measure the length of the pennant leg, also called the pole. Then project this length upward from the breakout point above the resistance trend line. This projected area becomes your initial profit target. Another approach is to trail your stop loss instead of fixing a single target. Think about it. Bull pennant patterns are often found in strong trending markets or right after a breakout from a range. In these conditions, the market may have enough momentum to continue far beyond the measured move target. The only way to ride that kind of move is by trailing your stop loss. To trail effectively, you can use tools like the 50-period moving average, ATR-based stops, or chandelier stops and exit only when price closes below your chosen trailing indicator. A smart way to combine both approaches is to use the projection method to lock in partial profits at your first target. Keep a smaller portion of your position running with a trailing stop to capture larger trends. This method can reduce psychological pressure and help you avoid major losses, even if the price reverses. Now, let's talk about where to find bull pennants in the first place. Pennants can appear almost anywhere: uptrends, ranges, even downtrends. But remember, a bull pennant is a continuation pattern. Our bias should always be toward long trades, not shorts. The easiest way to define a trend is to use trend filters such as moving averages. To identify a trend on the basis of short-term, medium-term, and long-term perspective, you can use moving averages such as 20-period, 50-period, or 200-period. So, how do we actually trade it in the range market? To be honest, we will not trade in the range. Now, what am I suggesting? This means that instead of trying to buy highs and lows within the range, we wait for the range to potentially end. This means that we look for tight consolidations or buildups that form a bull pennant pattern on the resistance. Therefore, The moment you see a bull pennant forming in the resistance, it tells you that buyers are becoming dominant and an explosive breakout is imminent. You can enter on the breakout candle, or you can also enter when the price closes above the resistance. And if you are lucky, you can also get a retest. Stop loss and target are the ones we discussed earlier. Since there is still no valid trend, if you want to trail your stop loss, you can use 20-period moving averages like tighter averages. Although bull pennant is a trend continuation pattern, there is still a way to make a profit by using bull pennant as a trend continuation pattern on the downtrend. This method has to do with market structure. This is a very easy way. To move forward, you will have to look for some things. First of all, the price should close above the downward trend line resistance. We're talking about the break in the downtrend structure. If the price forms a bull pennant above this trend line resistance, then you've got a jackpot trade. You're trading between an ending downtrend and a potentially starting uptrend. If you can catch that uptrend from the beginning, you can make a huge profit. Trade entry, stop loss, and target conditions will be the same. Just like the range market strategy, I still suggest using a tight trailing stop loss like the 20-period moving average, because we're taking a contrarian position. I will not go into all the details of the bear pennant, because this is exactly the opposite of bull pennants. This is a bearish continuation chart pattern, and it includes an impulse candle with a strong bearish body. After this, there's a tight consolidation with small candles and a contraction in volatility. We expect the price to break below the trend line support level and continue with the trend. Although this pattern is usually found in a downtrending market, we can still see it when the price is about to break below a support level, where a buildup is formed in the form of a bear pennant. You can also find it at the end of an uptrend, where the structure breaks with the bear pennant pattern. If I want to discuss entry criteria, then we will only look for shorting opportunities. Because the breakdown is expected to be explosive, when the breakout candle gives a closing below the trend line support, we can enter the trade. You can short below the low of the breakout candle. If the breakdown candle is very big and it's affecting your reward to risk, then it's better to leave the trade or wait for a pullback at the breakout level, which has fewer chances in the case of a pennant. So now you have to decide exactly where you want to enter. Make sure to validate the breakdown by using volumes, momentum indicators, or both. During the formation of the pennant, volumes usually decrease, and when the breakout occurs, they become higher than the average volume. Your stop loss can be kept above the swing high level of the pennant. Providing a buffer of 1 ATR above the swing high can protect you from unexpected overshoots and stop loss hunting. For the target, you can use the price projection method, measure the length of the leg and project it below the breakdown point. This projected level becomes your target. Or, if you plan to ride the trend, then use suitable moving averages to trail the stop loss. Exit only when the price moves back above the moving average. And that wraps up our deep dive into pennant patterns in the continuation series. You've now learned how to spot bullish and bearish pennants, plan entries, manage stop losses, and trail your trades with confidence. In the next episode, we'll move to triangle patterns, another powerful continuation setup you must know. Make sure you like, subscribe, and turn on the bell so you don't miss the next lesson.